Welcome back to Your Average Investor, the channel that looks at my journey through investing, budgeting and finance. Today we're going to take the opportunity to look at another one of the ETFs that I invest in on the Vanguard platform. And we're going to have a look at why I'm investing in it, what it includes and the return that I've seen so far. This is an ETF that I haven't been investing in for such a long period of time at the moment. However, it has seen an excellent rate of return for me over the last 3 months. This ETF is Vanguard's Emerging Market Fund, which obviously looks at markets which are not as popularised, such as the American market, the UK market, or some European stock markets. This ETF hosts excellent opportunities for growth because the companies are fairly small and because it's in an emerging market, they have lots of growth potential. This opportunity for growth does come with increased risk. However, we'll talk about that in the video when we look at the companies it includes, as well as the risk rating that Vanguard has given it. Let's hop onto the Vanguard platform and have a look at Vanguard's Emerging Market ETF.
To find Vanguard's Emerging Market Fund, we must first go to the What We Offer section on the Vanguard platform. If we scroll down via the Exchange Traded Funds, you can find Global or Emerging Market section. And here we see the FTSE Emerging Market. On initial viewing, you can see that it has an ongoing charge figure of just 0.22%. And of course, this asset allocation is 100% equity. You can see that Vanguard give this fund a risk rating of 6 out of 7. However, if we review the initial annual performance figures, you'll be able to see that over the last 5 years, 4 out of those 5 years, the fund has given a positive rate of return. Only 1 year, from 2017 to 2018, has the fund seen a negative rate of return at around 11%. After clicking on the fund, we can now have a look at it in a bit more detail. As with all Vanguard products, they offer a detailed breakdown of the fund itself, the performance, portfolio data, distributions and costs and minimum in this easy to use table. This is the same for the Vanguard Life Strategy 100, the FTSE 100 ETF and the S&P 500 ETF, along with all other Vanguard products. You can see that the current market price of one share in the fund is £48.83 and this fund is made up of 1,832 different stocks and companies. This really does show the level of diversification the Vanguard's FTSE Emerging Markets Fund does offer. As I've already said, the ongoing charges figure of this fund is 0.22%. When coupled with the ongoing account fee of 0.15%, you'll be paying a total of 0.35% for 1 year when holding this fund. This really is what sets Vanguard and its products apart from other companies, because these fees are extremely low and highly competitive in the investment market. Also, as suggested, the risk rating is 6 out of 7 at the moment, and this is largely because it's 100% in equities, but equally because it's the emerging markets, where there is obviously an elevated level of risk. Many of the companies in this fund are relatively unknown, and when coupled with their geographical location, this obviously also elevates the risk rating. By scrolling down, you'll be able to see more detail on this fund, along with the inception date, objectives, benchmarks, as well as the asset class that this fund falls into. If we scroll right to the bottom, we can see a past performance based on lump sum investment, and this really is where you can see the growth of the investment over time. You'll be able to see that over the last 5 years, if you invested £10,000 in October of 2015, that money would now be worth around £14,500. While this by no means challenges the growth seen using the S&P 500, it does add geographical diversification to your portfolio, and also invests in some of the more nuanced and emerging markets. If we look at the price and performance section of Vanguard's FTSE Emerging Markets, you'll be able to see a detailed breakdown of the historical prices, along with a price analysis over a period of different times, from the current date to the last previous 18 months. Here we'll be able to see the extent to which COVID-19 affected the emerging markets. This is largely due to the fact emerging markets are not as strong as larger, more well-established markets such as the US market and the UK market. You can see, however, that since COVID it has recovered and it's now reaching its all-time highs for this fund. If we scroll down further, we can have a look at the past performance again based on lump sum investment, and this time since inception of the fund. You'll see that the fund was developed and first sold in April 2012, and you'll be able to see that it's had large swings up and swings down in that time. And this is largely why the risk rating is 6. Because it's an emerging market and there's less stability within the geographical locations that the companies are, you can see this quite often. And emerging markets are more widely affected by things like global decline, climate change, and other things which do not affect the stronger markets as much. We'll now take a quick look at the portfolio data, and you'll see that the number of stocks in this fund is 1,832, compared to the benchmark of 1,837. If we scroll down a little bit more, you'll be able to see exactly where the regions are exposed to. Here, with 98.1% in the emerging markets, 1.7% other, and then 0.2% within Europe. And if we scroll down even further, we can have a look at the individual market allocation. And here we'll see that most of the market allocation is weighted towards China. Taiwan, India and Brazil make up 3rd, 4th and 5th, and we can scroll slowly down and see that there are a number of different countries included, such as Russia, Mexico, Qatar, Chile, Colombia, Greece from Europe, and also Egypt with 0.1% allocation. Now this really does give you exposure to a wide range of different countries, so this really does help to give you geographical diversification within your portfolio. We can have a further look at the weighted exposure of the fund, and we find that around 25% of the fund is stored within technology and just under 20% within consumer discretionary. We'll scroll down a little further to see that basic materials, telecommunications, healthcare, real estate and utilities make up the bottom of this allocation. We can also have a look at the individual holding details, and this is where we find that the Vanguard FTSE Emerging Market ETF is heavily weighted towards the Alibaba group, with it making up over 9% of the fund. Now while this isn't particularly a problem, it could mean that if this company had a poor year or something major happened with it in the news, it could affect the overall value of the fund. Again, it really does pay to fully understand the funds that you're investing in. This fund, along with many other Vanguard ETFs, does offer a dividend quarterly, and it yields around 2.1% per year. For those of you who are hardcore Trading 212 investors, you can also invest in this fund through the Trading 212 account, either via their Invest or ISA account. You can simply type in Vanguard FTSE Emerging Market or VFEM, which is the ticker symbol for this fund. The benefit of investing in this fund via Trading 212 is that you do not have to pay Vanguard's account fee of 0.15%. In essence, you may actually be saving money in the long term by investing in this fund through Trading 212 rather than on the Vanguard platform. If we have a look at my own personal performance with this fund, you'll be able to see that I've invested £508.65. The current value of this investment is £585.90, seeing a rate of return of just under 25%.
So there we are then, Vanguard's Emerging Market ETF. As I said at the beginning, it is an ETF that I'm fairly newly investing in when you compare it to Vanguard's Life Strategy 100, the FTSE 100 and the S&P 500, which I've essentially been investing in since I opened my Vanguard account in May 2019. I did get fairly lucky with when I first started investing in the Emerging Market Fund, with it slightly coinciding with the market dip after COVID-19. So I invested quite heavily through that period of time, and obviously I've reaped the rewards now by investing through the dip, now because it's strengthened and returned to its initial value, and somewhat exceeding that as well. And this brings me back to the point that I make in every single video. You should invest no matter what the market is doing. Over the long term, if you're in it for the long term, and you don't need the money for 10, 15, 20 or even maybe 30 or 40 years, then market dips really don't play a massive role in the value of your portfolio come the end of that time. The key here, as I always say, is to pound cost average into the investments that you are making and continue to do that over time. This really will see your investment pot grow to the largest size possible, and that is essentially what everybody in investing wants. If you've enjoyed this video, please like and comment on the video, and also consider subscribing to the channel if you haven't done so already, because it really helps the channel grow and push these videos out to more and more people. If you're new to investing, why don't you check out Trading 212 via one of my links below. By signing up to that, you'll get a free share valued worth up to £100, and so will one of my subscribers, because all the links below now are my subscribers' links. And if you fancy making a bit of extra money every single month, check out one of the match betting videos on my channel. This is a method that I've used to beat the bookies and make up to £1,000 every single month. I'm closing on £6,000 now in just under a year, so I'm really pleased. If that sounds like something that you could do as well, and money that you could use well, then why don't you check out one of those videos, or check out the link in the description below. As always though, thank you very much for watching. It really does mean a lot you guys watching these videos, liking them and commenting on them, and I'll catch you in the next one.